Do you avoid investing in stocks because you don't want to follow all these companies and know when to get in and out of an investment? Mark Seed from AllinOne is on the show this week to tell us how to get started on a buy and hold investment strategy that will give you dividend income without constantly watching the stock market. Welcome to the MapleMoney Show, the podcast that helps Canadians improve their personal finances to create lasting financial freedom. Make your money work harder with our sponsor, Wealthsimple. Get a bigger refund and pay lower fees with the Wealthsimple RRSP. Contributing to your RRSP is a great way to prepare for your future and get immediate savings off your tax bill. As a MapleMoney reader, get $10,000 managed for free when you open a new account or transfer your existing RRSP to Wealthsimple. Don't forget, the RRSP contribution deadline is March 1st, so head to maplemoney.com/wealthsimple today. Now let's chat with Mark. Hi, Mark. Welcome to the MapleMoney Show.
Thanks for having me, Tom. Appreciate it.
So I wanted to have you on. We've done a couple shows about investing, and I know it's a topic that you're very into as well. So I wanted to get sort of your take on investing, get your side of it, see how maybe it's been different than other shows we've done. So let's just hop right into it. And how did you get started in investing?
Yeah, well, my father wasn't David Chilton, but even still, he said basically pay yourself first, Mark. So, that's one of the things that I kind of learned early on in, I guess in my 20s, and that, you should really try to pay yourself first. And so it kind of begged the question back then, well, what should I pay myself first in? And I was always told, to invest in RSPs because TFSAs weren't around back then. And I'm kind of probably dating myself a little bit, but at the end of the day, pay yourself first, Mark. Try to put in like 5-10% of your net income if you can into investing. And so I put that money into to some mutual funds actually, so some big bank mutual funds back in the day, 20 years ago. And I just kept doing it. I started off with actually like $25, and I did a pre-authorized payment going into a big bank mutual fund, a blended fund. And I just kept doing it month after month after month. And that was really my foray, kind of after reading, The Wealthy Barber, David Chilton's book, that really got me interested in investing. I thought, wow, here's an opportunity to make what David Chilton wrote about, 8%, 10% return. And I started seeing some decent returns, even with the big bank mutual funds of the day, because things were doing quite well, back in the, maybe mid and late 90s or whatever. So, yeah, that was really my foray, Tom, into investing. And I kept doing it for a while until I basically saw a different light, which is there's a better way to invest and hopefully do it through lower costs and, less trading and avoiding penny stocks and any other things I heard in terms of my friends and anything of the like. So, yeah, that's basically how I got started.
So if you were mostly mutual funds at the time, do you remember back then what the fees were like?
Yeah, they were hovering around like low 2%, like maybe 2.1 or 2%. So yeah, I think I was in some big bank mutual funds. Basically, their equity mutual fund, which was probably cloning an index of sorts back then. I was in some science and tech funds. I was into some bond funds. I think I had at one point 8 or 9 things. And I think when the financial crisis came, that's when, probably when a lot of people had a bit of an epiphany, but I really had a huge epiphany. And I started really asking myself some serious questions. Like, okay, I'm in my early 30s now. What am I paying these fees for? What performance am I getting for these funds? Do I even have someone to help me out with the funds that I've picked and to rely on to give me advice? And so I started going down this road of asking all these questions, and I had a lot more questions than I had a lot more answers. And so it really started me to start thinking about, gosh, there's got to be some better ways to get a handle on my personal finance and investing than just throwing my money into some black box fund that I really don't understand.
Yeah, your story sounds a lot like mine. I also started in mutual funds, and most people probably do. They go to their bank, they go to their bank for a credit card or whatever too. But and I did something similar too, where it's before I even knew what indexing really was, I was kind of like, well, I need to be diversified. So I knew this idea, like I need this mutual fund and that mutual fund, and I needed this variety. But
Yeah.
In the end, that could have been done in a few ETFs, or even my first epiphany was to go to the TDE series. Still basically a mutual fund, but an index fund. Just the idea of lowering those fees.
Yeah.
So you did start a lot sooner than I did, though. I was late to invest, so I would much rather start early and have those fees than not start at all. So it's
Yeah.
still a decent way to get started, I guess, but not so much nowadays. Now, can we go into a bit? I believe you're kind of mostly into buy and hold. Is that correct?
Yeah, that's pretty much my philosophy in terms of whether it's the ETFs I own now, Tom, or even some of the U.S. and Canadian stocks that I own. I basically bought and held many of those companies for many years now.
Okay. Can you kind of explain for the listeners sort of what buy and hold is? I don't know if we've ever fully covered it on the show yet.
Yeah, fair enough. So it's largely at its core a strategy where after maybe some modest research, depending on the company that you're looking for. So let's take a Canadian bank as an example, like TD for an example. So maybe you, as a stock investor, you may want to do some research in the stock, how well it's performed in the past. Again, past performance is never indicative of future results, but again, that's the only kind of benchmark you have, right? Sometimes. So,
Fair enough.
for that kind of company, what's the growth been like? Has it paid a dividend? If it's paid a dividend, how long has it paid the dividend? Has it increased their dividend? If it hasn't increased their dividend, has there been great growth potential? And you see, year over year, that particular company earning more money. So I'm just using this as an example.
Hmm.
But there's hundreds, thousands of other companies that you could take. And so the concept around buy and hold is really after doing some of that modest research, that's the company that you buy and you try to hold it through thick and thin. So if the market goes down or the TD stock in this example goes down by 10 or 15%, you don't sell it. You actually may hold it. And in some cases, you actually may buy more because kind of like groceries at a supermarket, if those groceries go down in price, you probably want to buy them. Right? You don't want to buy your apples when they're sky high prices. You probably want to buy apples when you can get, a dozen or so at a really good cost. So the same philosophy can go for stock investing. You buy that company, you hold that company, and then where you can, you actually buy more over time. You don't really try to sell because there's a reason why you bought the company in the first place for long-term potential. And you can take a similar philosophy with ETFs, like you just alluded to, the TDE funds, but it's obviously a lot easier to buy and hold a TDE fund because you're much more diversified, to your point, right out of the gate. And so buy and hold typically relates to stock investing, but it doesn't mean that's the tried and true pattern.
Exactly. I consider myself buy and hold, but yes, with ETFs. And part of it's because I just don't want to be bothered to go through and constantly watch different companies or markets, even in the case of ETFs, and trying to decide if I need to get out. It's easier to sort of, I find, to rebalance just by buying the underperforming. Like you said, if something's cheap, if something's kind of down right now, it's basically on sale.
Right.
I've kind of liked the analogy before that if you liked a stock at $50, you should like it even more at $40. Assuming nothing's changed with the company, it just happens to be a bit of an ebb and flow. Then why not get more of that and kind of lower that overall price?
Yeah, exactly. I mean, again, for some of your fans of the show, they may be familiar with adjusted cost based or those types of things. But to your point, if you're a fan of the stock at 50 and it goes down to 40 or 45, there's no reason if the fundamentals of that company are still the same, why not buy more at that time, right? And all things being equal, stock prices tend to go up on average, 6, 7, 8% over a long term, right? That's what historically they've done. So, the collection of those stocks will grow to 7 or 8% over time. Will the TD stock grow at 7, 8%? It may or may not. But as an individual stock buy and holder, you're obviously hoping for that return, if not more, whether it's through capital gains, i.e. price appreciation, or through the dividend as well.
Yeah. And obviously a big benefit of buy and hold, especially with individual stocks, is those dividends. Do you mostly invest for dividends, especially say in like Canadian stocks?
Yeah, that's definitely my bias. When I looked at the Canadian market many years ago when I was coming out of that financial crisis, and I kind of looked at what companies tend to be at the top of, all the broad market mutual funds. So that big bank equity mutual fund or low cost ETFs that you well know, Tom. There's the Vanguards out there. There's iShares. BMO has a nice suite of funds as well for low cost ETFs. So there's a lot of companies that are offering some great products now. What I noticed back then is a lot of these same stocks kept appearing in the same big fund, right? So you had Canadian banks and you had Canadian utilities and Canadian pipeline companies and some railroads. So it's like a mini monopoly, right? You have banks and utilities and railroads. And I thought, well, maybe I should just hold those companies directly because all these other funds do kind of the same. So that's really what I did for the Canadian market. I find for the US market, it's a totally different story because our Canadian market is predominantly 40% financial, about 20% energy, and throwing in a few materials and telco stocks, you're at 70% of our economy in those kind of massive mega companies that we all kind of know in Canada. The US, it's much more diversified. You've got, 10 or 15% in healthcare. You've got consumer discretionary stocks. Think of the Coca-Colas and the Pepsis and the list goes on, right? So it's much harder, I think, to really, I would say, stock select and get similar market-like returns in the US than you can in the Canada. So yeah, my bias is really to buy and hold a lot of the Canadian stocks for dividends and for growth.
Yeah.
But really, as I get more mature in my investing, hopefully I'm getting more mature. I'm really gravitating to more low cost US ETFs to really ride the US market return. And that seems to be a kind of a hybrid approach. I call myself a hybrid investor, but that's kind of my hybrid investing approach that I've really kind of gravitated to in recent years.
One thing you mentioned was the idea of buying certain things, especially Canadian stocks, because you can pretty much make up the whole ETF. I think I might have mentioned on this show, so I hate to be redundant, but one thing I've done is the REIT ETF. It was, I think I own like 4 different REITs, and basically that is more than the majority of the entire ETF, which is kind of a high fee ETF, and it's not that high. It means like over 0.5%,
Right.
but it was just easier to buy a few of these individual REITs and make up the whole market. And I never really thought about doing that with the Canadians. I had a lot of Canadian dividend stocks. I sold them and got into ETFs, but I never really thought about the obvious fact that if you own 5 banks and 5 energy companies, you kind of gone a long way already to having what is Canada.
Yeah, no, it is, and I've done the same too, Tom, with my REITs. I think I don't remember all the tickers, but you got like a ZRE and from BMO, and you've probably got an XRE from iShares, and maybe a VRE from Vanguard, and those are the suites of the REIT ETFs that you talk about. And you're right, they hold very similar companies, maybe in different weights and different kind of caps, but you've got RioCan in there, that was the box stores kind of ownership, right? You've got H&R REIT, which I think is in your hometown, Calgary. They own probably a lot of office buildings, and so you've got the office buildings. You've got Canadian Apartment REIT, I think, as well. Which again owns various apartment buildings for residential REITs. So again, you own a few of those REITs, and then you basically started to unbundle, if you will, the REIT ETF. And I've kind of taken a very similar approach with the Canadian stocks, but it took a lot of time. I mean, it's been a 10-year journey to build a portfolio. So this isn't an overnight success story, but it's hopefully a get wealthy eventually strategy.
Yes, exactly. And in no way am I saying that the ETF isn't worthwhile, because if it's 0.5%, that's not that bad. It was just in the world of ETFs, it was like, well, that's kind of the high one. I can avoid that, and it was such a small group. Like literally, I think I own 4 different ones, and that kind of is more than the majority of the ETFs. So it seemed like an easy choice.
Yeah, exactly. And everyone has their own different approach. But I think, to your point, I mean, owning a REIT ETF and owning a Vanguard or a iShares or a BMO product or a TDE fund for your Canadian content, and then looking at a couple more ETFs for like probably you do, Tom, your U.S. and your international diversification. Within a handful of products, you've got the world covered. And what better way to invest than to do that for most investors? I think it's great.
Yeah, exactly. So all this talk about buying and holding and collecting the dividends, this starts to sound a lot like the FIRE movement, which is becoming a big thing. Sort of this idea that it's got a lot of great principles. Like don't spend a lot. So there's sort of the frugality side, and then invest that money and live off that. What are your thoughts on that?
Yeah, I find the FIRE movement interesting because again, it's kind of like back to David Chilton. I think if he was a millennial, this is something that he would may write about. Is financial independence, retire early with paying yourself first and spending less than you make and living below your means. I mean, these are all principles that have been around long before the wealthy buyer movement, but he tended to popularize it, right? So I'm not against the FIRE movement. I think it's got a lot of great merit. Again, for all the reasons I just said, I think the concept is really good. I think the whole focus around certain goals, around having enough income to cover your expenses. What I struggle with a little bit are a couple things. One is I don't think financial independence is something you should be running from. Maybe again, maybe a lot of people are running from a job they don't like, or maybe people are busy just grinding it out for a few years to live really frugally only to travel the world or do other things. And I just think it's not wasted time, but I think where I struggle with a little bit is if you're not happy, make a change sooner than later. Don't try to gut something out for 10 or 15 years and be miserable only to come out the other side and saying, guess what, I'm retired now and I can do whatever I want. So I struggle with that a little bit. And I think the other thing that I kind of struggle with is, for folks that say they're retired, but they're potentially running a blog or they have royalties or they have rental income or other things, I think folks need to be just maybe a little bit more transparent about, what they mean by retirement or financial independence. And so if you're still working for a living, but maybe you're working on your own terms, I think that's great. But I wouldn't necessarily call yourself retired if you're still working per se. It kind of doesn't really jive with the definition. So, for me, I kind of want buy root, and I don't know, you can trademark that or whatever, but it's kind of like financial independence, working on my own terms. It's not so much, financial independence and just retiring and not doing anything. So that's kind of my take on it, really.
Yeah, and in general, I wonder if I don't know if the definition of retirement seems to be changing a little, anyways.
Sure.
Let alone FIRE, but what you're saying about this sort of working in retirement, that's becoming more of a trend. Even if you're 80, you retire and then you go work the door at Walmart or you go to Home Depot because you like working with tools and wood and stuff. So it's I don't know.
And I think there's nothing wrong with that, right? I think if people want to retire or semi-retire, or the concept of victory lap and doing things on your own terms, I think that's awesome. I think it keeps you maybe young at heart. It keeps you socially engaged. It keeps you maybe more financially secure. And I think those are all great things. But I think just trying to be financially independent and run away from something. I don't know. I just don't get the concept. I'd rather work towards something, I guess. So it's just maybe how I'm providing the context about what it means to me. I have nothing against the principles. It's just, I wouldn't want to spend 15 years trying to run away from something. I just don't know if it makes too much sense.
Yeah. If you're the kind of person, I know there's different people within the FIRE movement, but if you're the kind of person that's sort of, like you said, giving up a decade to to benefit after, and there's been a few people that brought up like, well, what happens if the market goes down? That it could pop a few FIRE bubbles where people think they've got enough money. No, again, no different than regular retirement at say 60, 65. You think you have a certain amount of investments, that'll get you so far, but if the value of those drop or anything, then it could be a real test.
Yeah, and I think the other thing too is the biggest wild card for any early retiree is really your health, because you don't really know, none of us really know how long we're going to live. I mean, retirement planning would be very easy if we all knew the end date, and that would be very morbid, but also very easy for financial planners, right? But I think at the end of the day, you're going to retire early, which again, I nothing wrong with that. I mean, my wife and I want to have some sort of semi-retirement, and probably in our early 50s, and that's something we aspire to. But we won't necessarily stop working. We'll take different jobs, or we'll keep our same jobs and maybe do them a little bit differently, hopefully. But all that said, I mean, I think the biggest wild card for any early retiree, someone that's retiring in their 40s and 50s, is the healthcare risk in terms of, hopefully no one gets sick long term. Maybe your parents need extra care, and you want to take care of your family or your parents. So there's all these kind of factors that play into a long life cycle, if you will, without having a particular fixed income. So it's just something that I think people need to think about. And your point around the market dropping, yeah, who knows if and when that'll happen, but by and large, there's always those cycles too.
Yeah. So we mentioned fire as a trend, and we've mentioned ETFs. So one thing I wanted to get your thoughts on were some of the new things. We've got robo-advisors, and we've got AllinOne ETFs. To me, both seem like an even easier way. Granted, there's always higher fees that come with that, but they're still pretty good compared to mutual funds. So what's your thoughts on either of these, robo-advisors or the all-in-one ETFs?
Yeah, I'm a huge fan of them, and I'm actually starting to give some thought. I'm a passionate dividend investor, and I have the US ETFs, like I mentioned, but I'm actually giving some thought into putting some of our financial assets into these all-in-one equity funds. I think Vanguard just recently released one. I think iShares got one out too, and other companies will probably follow suit. I just think it's great. Like, here's an all-in-one fund that a young investor, maybe someone that's halfway through their career like myself, or someone that's early retirement, maybe they got a pension or other things. And here's a product. It doesn't have to be all equity, but here's a product that offers built-in diversification. All the balancing is redone for you, and for a slightly modest fee, maybe 30 basis points or something like that, well below your REIT ETF and way below my 2% when I was investing in mutual funds. Here's a product that basically does it all for you, right? And you don't have to worry about putting it necessarily in your RSP or TFSA. It's basically find a home for it, invest it, and withdraw money or sell units of it as you need to, and let the thing grow. And I think these are awesome products for millennials just starting to learn invest, anybody in any age. On the robo front, I think it's great. You've got the fintech, the financial technology kind of helping people with the whole investing algorithm, right? So do I need a fund from the US? Do I need a fund from international? Do I need a Canadian fund? So you've got that kind of the algorithm, the software doing the work. Then you still got a warm body behind the scenes that you can also call, interact, and actually have a real conversation with. So I do like the robo blend too, because for people who want that personal touch at a lower cost compared to certain products you and I grew up with, I think it's a great solution. And then you've got all these apps, like you've got Milo, Spendy, Mint, like on the touch of your phone, you can figure out what you're spending, why you're spending it there. You can track some of your budgeting. So for people who really hate budgeting and don't like Excel and spreadsheets or whatever, you've got apps that can do all the heavy lifting for you. So I'm a huge fan of the fintech, and I think it can only get better. And this is a great age for millennials or anybody else that are really trying to get a handle on their personal finances. There's never been a blend or a bevy of tools available to help people.
Yeah, I've been considering going probably to a robo-advisor, at least trying it out, because I think it's great for anyone getting started. But I think it's, in my case, I'm just kind of, I used to find like rebalancing fun and exciting. It's less exciting now. I'm thinking like, this is one thing I could take off my plate, kind of thing. So or the all-in-one ETFs, but just the idea that one less thing to do, it sounds good to me. So
absolutely. And I think you have to understand you have to understand your kind of own behavior, right? Like, you're a busy guy, I'm a busy guy. There's everyone out there's busy, right? So how much hours in the day do you really want to spend doing some of this stuff? And if you're really passionate about it, that's great. But a lot of people don't have the time, even if they're passionate about it, because they've got family obligations, they got work commitments, they got their personal time they want to take care of.
Exactly.
And so, look at these solutions as an opportunity for you to kind of offload some of the things that you know you need to do, but someone can do it for you at a very marginal incremental cost. And again, compared to the products of the 2% days or 2.5% fund days, there's some great alternatives out there, whether it's the robos of the modern advisors or Wealthsimple or Just Wealth. I mean, these are just a nest wealth. There's just a handful as mentioned, but they're all out there and they're all ready to help people at a much lower cost than you could ever do before.
Yeah, and similar how you mentioned Milo as well, like the idea that you could be putting little bits of money aside without you having to do it. Like it's all automation now. whether it's something like Milo or something like Wealthsimple, it's like it's an app, it's automated, it's low fees. There are fees, yes. It's not the absolute cheapest option, but it's it's so low that it's not a huge issue.
Yeah, exactly. And ultimately, the fees you pay, yes, that's a factor, but I think people need to think about kind of like just the treadmill that sits in the basement and collects dust. You have to think about the behavior, right? So as long as you're down using the treadmill, you're going to get value out of the treadmill. As long as you're using the app, as long as you're using the robo-advisor and paying yourself first, it's the behavioral change that's going to pay way more literally in dividends or anything else than a small incremental fee you're paying all the time. So that's just my thesis on it all.
Sounds good. Well, thanks for being on the show. Can you tell everyone where they can find you?
Yeah, for sure, Tom. So for folks that haven't seen the site or haven't subscribed yet, please check it out. It's called myownadvisor.ca. I've actually been running the blog for almost 10 years. It's hard to believe how fast time goes. But I still enjoy it. It's still a great passion and hobby of mine. I put out a few articles every month for sure. I try to put out at least one quality, if not two quality articles every week. You can read about my dividend investing strategy, low cost ETFs, robo-advisors, any small behavioral changes to save a little bit more money and keep more money in your pocket. Definitely talk about insurance tips and how to avoid pricey products on that front. So definitely check out myownadvisor.ca and happy to connect with you.
Thanks for being on the show.
Thanks so much, Tom.
Thanks to Mark for sharing his buy and hold strategy. You can find show notes for this episode at maplemoney.com/markseed. There are only a few days left to enter the MapleMoney 10th anniversary giveaway. If you haven't entered yet, you have until March 2nd to get a shot at one of 10 Amazon.ca gift cards worth $100 each. You can enter at maplemoney.com/giveaway, and if you've already entered, you still have time to get additional entries by using your special link to refer others. Thanks for listening, and I'll see you next week.